Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name's Manpreet, and welcome to Through the Noise. Now, it's election season in the US, France, and the UK, and the screaming headlines are out in full force. The UK election, of course, now concluded, and we'll have greater clarity on the political fortunes of key players in France by the end of the weekend. In the US, though, it's still not clear if Biden will continue as a presidential candidate. Financial markets, at least, appear more convinced of Trump's candidacy after last week's debate. Now, just how important are elections actually for financial markets? To discuss this and more, I'm joined by Rajat, who's Senior Investment Strategist at the CIO office. So, welcome, Rajat. Thanks for joining us today. Markets clearly increasingly convinced that Trump will be the next US president. How should financial market investors consider the impact of such an outcome?
Hi, Manpreet. Yes, you're right. Polls are showing that former President Trump's chances of winning the November elections have soared after last week's debate with President Biden. Now, while Democrats are reportedly exploring a candidate to replace Biden, markets are starting to price in a Trump presidency, as you mentioned. US government bond yields, for instance, and equities have risen since the debate on the view that a Trump presidency would lead to further tax cuts and higher fiscal deficits. However, I should say that two factors are likely to cap any significant rise in bond yields and negatively impact global equities. One is a decidedly slowing US economy, and we're seeing recent data supporting that. And the second one is likely import tariff hikes that Trump is likely to impose once he returns to power, if he returns to power, I should say. Now, Friday's US job market data and next week's consumer inflation data for the US for June and the second quarter corporate earnings are the key indicators to watch in this environment. So, any signs of further weakness in both the job market or inflation, or even in the corporate earnings, is likely to raise the chances of Fed rate cuts earlier than markets are currently anticipating. And the markets are pricing the first cut in November, so they could, hasten the first rate cut as early as September. Now, we believe the risks are broadly balanced in this scenario, and thus would maintain an almost balanced allocation with a slight tilt towards US equities. In the near term, there are opportunities to lock in the elevated government bond yields in the US after the Trump inspired bump up in yields, and in Europe because of the elections that you mentioned in France.
Thanks, Rajat. Well, let's move right to those across the Atlantic. We've obviously had the conclusion of the UK election, and we'll have one in France over the weekend. So, for currency markets, what do these mean for pound sterling and the euro?
Yes, so let's start with the UK first. So, after the Labour Party's expected landslide win, the bias for the sterling against the dollar, that's the cable, maybe to the upside for now on a brief relief rally. Labour Party win is largely priced in, I must say, and currency volatility has been lower than levels experienced during past elections because the outcome was fairly known. And the focus now remains firmly on the BOE policy, the Bank of England policy that is next in the coming weeks. For now, we expect the sterling against the dollar to test resistance just above 1.28 amid a largely range bound 3 month outlook for the currency pair. Now, the key question is how the incoming Prime Minister, Sir Keir Starmer, pays for the campaign promises that were made about improving UK's public health care, education, infrastructure. We think that tax hikes are the most likely way to fund those ambitious programs. But the UK economy faces an economic slowdown in the coming months. So it will be interesting to see how they deliver on their promises. Markets will be very closely watching the government's initial statements and the first budget whenever that happens. In terms of the euro, the currency may be set for a brief rally like the pound in the next couple of weeks. The euro dollar has dipped briefly below 1.07, alongside the surge in French government bond yield, and this was because of the surprise French election announcement by President Macron. However, market concerns of an absolute majority for the far right national rally has been abating. And why? Because the national rally is supposed to be raising the fiscal deficit. Now, if it turns out that they are not in a position to win that absolute majority, then there's it's chances of the bond yield spreads and the bond yields in France declining and the euro rebounding. The euro has already, testing near its 200-day moving average. Short of an absolute majority for the national rally on Sunday, we expect markets to quickly move on. This likely means a relief rally in euro dollar towards resistance at 1.09 and 1.098 over the next 1 to 2 weeks, after which the focus is likely to return to the likely path of ECB rate cuts. The next ECB policy meeting is on 18th July, and we expect the euro dollar to move to 1.06 over the next 3 months as the focus turns towards ECB rate cuts in the coming months.
Okay, so let's move on maybe to equity markets now beyond elections. So the other key event is the start of the US earnings season, the second quarter earnings season next week. Uh, in your perspective, what should our listeners be watching out for as we kick this off next Friday?
That's correct. The earnings season takes off with this major U.S. bank earnings, which starts on the 12th of July. Now, the consensus estimates for the S&P 500 index is for a 10.6% year-on-year earnings growth in the second quarter, and this is led by the communication services, healthcare, and technology sectors. Earnings expectations for FY24, so that's full calendar year this year, has been revised higher to 10.7% from below 10% at the start of April. Now, we believe there are three drivers of US equities in this scenario. The first is the positive earnings revision in US markets. The number of companies with upward earnings revisions are exceeding those with downward revisions. The second is the US markets, the US equity markets' strong return on equity. And third is the potential Fed rate cut in second half that I talked about, which will support a continued uptrend in U.S. equities, especially in the growth stocks, despite all the macro uncertainties. In particular, we prefer the sectors with high earnings growth expectations, such as the technology and communication services sector, which are likely to capture the rising momentum in AI related investments and cloud computing. We also expect the AI theme to broaden out from the initial Magnificent Seven companies to other subsectors in the technology sector, including semiconductors, software, and AI powered personal computer companies.
All right, and maybe finally, just on Japanese equities, we've seen performance pick up, at least in Japanese yen terms. So, in your view, is it time to once again consider adding exposure to Japanese markets?
Yeah, the Japanese equity market is an odd one. They have had a strong short term positive momentum, and that's primarily because a weaker yen continues to be the key driver. The tailwinds from the global technology sector rally that I talked about is another big driver, and this is enhanced locally by the favorable business plans from some of Japan's semiconductor companies. On balance, we maintain a core holding, which is basically a neutral view on Japanese equities. This is because we believe the yen will strengthen over the next 12 months, led by an eventual divergence in monetary policies between the Fed, which is going likely to ease, and the BOJ, which is likely to tighten. While a rebound in the yen may temporarily weigh on Japanese equities, it's likely to be offset by positive fundamental factors, including improving corporate governance in Japan. In addition, the valuation for the MSCI Japan index continues to look reasonable at the 12-month forward PE of 16 times earnings. So this is around the historical average currently. Within Japanese equities, of course, there are some opportunities, and the big one are the Japanese banks, given improving interest margins and profitability. The 10-year Japanese government bond yield has been on an uptrend. Potential tightening from the Bank of Japan and steepening yield curve would also boost banks' earning interest income. Recent inflation data has been supportive of our idea, with the Tokyo CPI ex fresh food rising to 2.1% in June from 1.9% in May, which is above market consensus. So we do see a scope for the Bank of Japan tightening, and that should lift bond yields and the banking sector in Japan.
Thanks, Rajat. I guess we can continue the conversation, but we're now about out of time, so we'll take a pause there. If I can summarize, as always, some of the top takeaways from today's conversation. First, of course, we've seen several sort of jumps in U.S. and Euro area bond yields as a result of politics related uncertainty. This, of course, could be an opportunity to add. Second is the euro in particular could see a short-lived bounce, at least over a couple of weeks between now and the ECB meeting. Once sort of the French election uncertainty concludes. And third, of course, keep a close watch on the upcoming US earnings season that kicks off in earnest next week. So thanks, Rajat, for taking the time to join us today. And thank you, listeners, for taking the time to dial in. As always, we hope you enjoyed today's podcast, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.